Christian Batchelder, welcome to the Bigger Pockets YouTube channel.
Thank you. We're back at it again, round two.
By popular demand, the first video that we made did so well that people were emailing us in Bigger Pockets and saying, we want more of Christian.
Well, here it is.
So here we are. That's exactly right. So since the last time we talked, obviously the market has shifted some. Interest rates have gone up. The market overall has slowed down. That's not true of the market in specific locations, but in general, that is the case. We should talk a little bit about how that works to the people who are sort of newer to real estate. But can you tell me what's been happening in specifically the mortgage market since we last spoke?
Yeah, I mean, rates have continued to do what we expected they did. They were doing this earlier in this year. They are going up. I do anticipate, as I've continued to say throughout this year, I'm a firm believer that the lowest rate you'll get for the remainder of this year is right now. I said that in January, I said it in March, and I'm saying it now. I think they will continue to rise as the Fed continues to try to combat inflation. I think that's really the only option in this corner we've backed ourselves up into, unfortunately. But yeah, I think rates are just going to keep going up.
Well, that's also based on the fact the Fed has more or less said we're going to keep increasing rates, right?
Correct. Yeah, and obviously, with the Fed doing that, the mortgage interest rates Fed doesn't raise interest rates, for those that understand, on mortgages specifically, but there is a correlation typically when Fed rates go up, mortgage rates do go up as well. And obviously the ever evolving connection between supply and demand, that has a say in it, right? That's kind of why real estate and stocks and crypto and everything have kind of taken their first big hit. Real estate's starting to plateau a little bit, but we're not decreasing values to a crazy amount yet, right? How we had 40-50% losses in the other asset types, and that is because of that supply and demand kind of countering to the inflation argument.
So with the clients that we have at the one brokerage that are getting loans from us, we see the deals that other people are doing as well as that I'm doing and that you're doing and that the David Green team clients are doing. So we kind of have this holistic view of the market in general. What are some of the trends you're seeing as far as asset classes, price points, et cetera, that are being affected by rising rates more than others?
Yeah, 100%. I think obviously short-term rentals I see is still going strong. There's been some softening. Airbnb just kind of changes up their algorithms, but I think those are still obviously the biggest sector that people are rushing to. I will say I'm seeing an uptick in more unique properties. We're doing a couple loans for some tree houses and some unique things right now that are actually shockingly difficult to fund, but that do really well, right? I think a lot of people are still targeting those unique stays as opposed to the standard, single family on the end of the cul-de-sac. I do think first-time home buyers are having a hard time right now. The borrowing power that they had last year has been cut in half because of interest rates.
Yeah.
So, I mean, there's definitely is a downturn on that, but investors, at least that we know, are still going strong. We still know multiple people in multiple contracts. David, I know yourself is buying. That industry is still chugging along. I don't know where it will go for the future, but we're still seeing a lot of strong borrowers buying a lot of property.
We are seeing investors still buying, but specifically, what type of assets do you see them getting better deals in?
I do think as rates go up, I mean, it's not really specifically asset type, but we are seeing a lot more of the negotiating power of the buyer come back. So we're seeing some ability to get seller credits that you weren't able to see before. On these short-term rentals and these vacation homes that people are buying, you had to over asking. You had to waive your appraisal contingencies. You had to do all these things in order to get something in these competitive markets like Florida and Tennessee. And now you're able to, that negotiating power is kind of swinging back into the realm of the borrower, which is nice because as the rates go up, that can be a combating force that kind of buys them back down. You can get a rate from 2 or 3 months ago if you have enough credit from the seller to buy it down.
And that's my next question. Very smart of you to take it there. One thing that we've been telling the clients that are in our brokerage is basically it's based on the strategies that I use when I'm buying houses and that Christian used when he buys houses, right? So if you sell your house with the David Green team, this is what I do when I sell my homes. If you buy a house with us, this is the strategies we use. So as sellers are being forced to take some price cuts, it's hard for them to know exactly how far they have to cut. So I'll give you an example. Someone lists their house for $800,000. It sits on the market for 45 days. It's clear to the seller and the listing agent they have to reduce the price. It's not clear by how much. So they reduce the price by $25,000. They come down to $775,000. It sits another 30 days. Nothing's happening. Now they're trying to figure out, is it that no one wants my house at all? Is no one buying in Florida? Will another price reduction even help? Should I take it off the market altogether? Now fear, now pain, now chaos starts to enter into their mind, and they go from the greed of, I'm going to get 10 offers with no contingencies after I listed 800, it's going to sell for $1 million. And it quickly swings into, does anyone want my home? And you're watching financial news and you're hearing stocks go down, crypto goes down, Bitcoin at all-time lows. It creates this panic. And as a buyer, we're actually looking for that. That's why I believe I have around 12 houses in escrow. Christian would probably know better than me. It's probably somewhere around that number where I'm buying them because the sellers are overreacting. They are dropping their prices way too much. So what you do is you write a very aggressive offer, and that tells you where they're at. Are they in a panic mode, or are they like, no, I don't need, I'll just kind of stick around here. Now, here's what I'm getting at. For this person listed at 800 that's dropped to 775, now it's been a total of 45 plus 30 days, so 75 days on the market, and they're seeing prices just are softening even more. They don't know how far they have to drop their house to. So if you come in and write an offer at 700,000 with a $15,000 closing cost credit, there may be a person out there that takes that, and that $15,000 closing cost credit sort of gets lost in the shuffle.
Yeah.
They were going to drop it anyways. Maybe they were thinking 725. You say 700. They don't like it, but they just heard Jerome Powell tell people to stop buying houses. In that state of mind, they say, oh, screw it. We just need to move. There's enough equity. Let's sell before it gets worse. You now have a $15,000 closing cost credit when they might have said no if your offer had been 685, which is the net to them, because that 6 at the beginning looks a lot scarier than a 7. Now you are buying your rate down, like Christian said, to what rates were 4 to 6 months ago. It's actually more palatable, and you got the seller to pay for it. So your skill, the skill of your real estate agent is very important when the market is either dropping significantly or climbing significantly. And it's at this stage, it's dropping significantly in certain markets. And then your toolbox, what you know that you can put to play here. Did you even know you can buy rates down? Did you know that you can use money from the seller to do it? So, Christian, from your perspective, the guy who's kind of sitting in the crow's nest and seeing the 200 mortgages or so that we have in underwriting right now, what advice would you give to people that they should tell a realtor who doesn't know what you and I are talking about now?
Yeah, 100%. That's a really good question. And I'd say really formulating connection between your realtor and your loan officer, right? Kind of starting to view them as a tag team instead of individual, participants in the transaction. Obviously, the rate buy down is a big one. Knowing where the max pre-approval lies. Some people find a property $20,000-$30,000 over their pre-approval limit, and they think it's unattainable. But staying in touch with us and making sure that you can go get that, and there is some wiggle room. We always pre-approve with wiggle room, but not everybody does. But really just utilizing the knowledge of your realtor, the knowledge of your loan officer, and really putting them together to put you in the best position, whether it's requesting a rate buy down, whether it's requesting seller credit, whether it's increasing your pre-approval amount, running rental comparison numbers, right? A lot of realtors can look up what a property may rent for in an area if you're targeting an investment property. All those kind of things that it really helps when the loan officer and the realtor are a team as opposed to individuals, right? If they're not on the same page, you may be missing out on a really good opportunity.
That's a very good point. Now, you work with several agents, and you are a real estate agent, and you're a loan officer. This is one of the reasons that Christian and I's partnership has worked out well, because we both kind of approach real estate the same way. Yeah. We're like, I know all of it. I love all of it. I kind of want to do all of it. But it can only happen if I have systems in place. So when a person is choosing a realtor, let's say they come to us to get their loan and they say, hey, I don't have an agent in the area. What should I look for? If we have an agent, we can obviously refer them to that agent. But if we don't, what are some things that people should look for in a real estate agent?
Yeah, great question. I'm a strong believer in tying your type of agent to the type of property you're looking for. If you're looking for a first-time home buyer, work with an agent that has some experience with that. Work with an agent that knows which areas are safe, where the good school districts are, where the good amenities are that you may want to have a park nearby, right? That you can take your kids to. Whereas the short-term rental specialist is going to know how to run comparables. I mean, David and I experienced this ourselves, searching through short-term rental agents, and a lot of people call them a specialist, but they're not, right? We've been lucky to find a couple that can run numbers really well, and they can, target a specific area and give us the breakdown of what amenities are in this area, right? You have to think about a short-term rental or an investment property a lot different than you would for a first-time home buyer, right? So I mean, I think really getting an agent that knows the asset type that you're buying is super important.
That's a very good point, and I would second it. I know when I'm looking to find an agent, when I want to buy short-term rentals in a market, I want an agent that owns short-term rentals.
Yeah.
When I'm looking to refer clients that are going to be first-time home buyers, I'm looking for an agent who has kids that maybe recently purchased their first home. They've been an agent for a while, but they understand what's in those people's heads and their hearts. And so when you're using the Bigger Pockets agent finder feature, or you find some agent at a meetup that talks a big game, you should be asking them a lot of questions about that asset class. And they should say, oh, I have properties in there and this is what they're doing. This is the person I use for my pool maintenance. If they can't say that, you're going to be doing a lot more work trying to go through, Google Pool Services and figure out the person that you want to use. It's a big help.
Absolutely.
Another thing that I want to ask you, Christian, is in the mortgage space specifically, meaning the type of loan that someone gets on a property, there's ways that you can make deals work that might not normally work. We have a lot of flexibility at this stage with what loan products that we can offer human beings. So for instance, some people may say, hey, I want just the best rate possible. And a Fannie Mae, Freddie Mac is usually going to be the case. But after you get so many of those properties, you can't get any more. Or your debt to income ratio doesn't support those types of loans anymore because you have too many loans, or maybe you haven't been claiming all the income on your taxes, and shame on you, but sometimes that happens. So in those cases, there are loan products that will use the income from the property as opposed to the income from the client. In other cases, you'll have different loan products that may have a 5, 7, or 10-year adjustable rate. So your rate is locked for 5, 7, or 10 years. It's lower. It could be interest only. Now, not all these products work for every person.
Correct.
But we do have things like a 15% down investment property loan, right? Or 10% down second home type loans. Can you share some of the more common loan programs that you're seeing that are actually either saving investors money so the deal is better, or allowing them to keep buying when they normally otherwise wouldn't be able to?
Yeah, absolutely. And it's the same situation that David and myself find each other in. We don't qualify conventionally anymore, right? Neither of us do. And it's funny, I've always told people the Fannie Mae guidelines are not really written to make investing easier, right? They're really good for first-time home buyers. They're good when you don't have a whole lot of debt. They're great when you don't have a business, right? When you have a business, they're a nightmare, right? When you have anything that requires any sort of finesse on your taxes, Fannie Mae doesn't reward you very well. They try to hit you with all of the downfalls and give you credit for none of the upwinds, right? And that's where these products, 12, 18, 24 months ago, these were not popular at all. Nobody was using these other loan products because the rates were so low, everybody qualified conventionally, right? I won't say everybody, but the vast majority of people did qualify conventionally. So they were pursuing those low interest rate, high underwriting criteria loans, Fannie, Freddie, FHA, yada, yada. About 12 months ago, we went and secured relationships that allowed us to be the most competitive in the space with these loan products. A lot of the listeners probably have heard the term DSCR by now, right? That's basically a loan product that allows us to use the rent from the subject property and doesn't really care about how your taxes look, right? It doesn't really care about what you report or your business that you take a big write-off on, or your real estate that you take a big write-off on. It really just cares about it's called a business purpose loan because the idea is you're purchasing a business, not really real estate. And this works well for investment properties.
This is how commercial properties have had lending happen for as long as I've been around. It's just taking commercial principles, which frankly are more sound and probably safer than the residential way that we do it, which is based on income that you're making that could change, which is based on how you personally manage your finances. It doesn't really make sense if you're buying a house and as an investment property that your financing is the same as like Bobby and Susan, who are buying a house because they just had their second kid and they're both school teachers. So
correct.
This isn't risky, scary, subprime type stuff like what you people may think when they hear this. It actually makes more sense for an investor. And this is how bigger deals from professional people have been done for a long time.
Yeah, that's a really good way to put it because a lot of people hear no income restrictions and you're exactly right. They get 2008 vibes, right?
Yes,
in 2008,
it
wasn't DSCR loans that crashed the market. I can promise you that, right? It was the loans where people were just fraudulently putting what they made, right? They were getting qualified for the quote unquote conventional loans at that time with no oversight. So you're absolutely right. Yeah, it is a business loan.
If we had DSCR loans back then, people would have not been approved for the loan they got.
Yeah.
If they were forced to do a loan off of cash flow, the market would not have crashed.
Absolutely. Yeah. And I mean, if your rents are, in an area where there's good comparables, which is part of the DSCR underwrite, if it's in an area where the rent is going to we call that debt servicing, right? It covers the debt service. You're essentially buying a cash flowing asset, and the lender wants to lend on that, right? And it's going to take anywhere from 15 to 25% down. So you also have some skin in the game, right? Whereas in 2008, people were able to do 0% down, no income loans, right? The moment we had a 10% decrease, everybody's underwater, right?
So we're able to get exceptions for people, and we're able to get lenders to look at things from a different perspective because of the volume of loans that we're doing in that DSCR space. So if you're somebody who says, Absolutely. Man, I got this great opportunity to buy this $900,000 house. It's going to cash flow crazy good. There's super solid comps, but I'm only approved at $600,000. That's a person that should look into a DSCR loan because they can get approved when they normally wouldn't be. Correct. Now, what about the adjustable rates that we're seeing? Are those risky? Is there a way to do it that's less risky? Who's the right person to be going after an adjustable rate loan?
Yeah, super good question. And just so everybody understands, adjustable rates, as David said, 5, 7, or 10-year periods. They can be interest only. Obviously, just inherently by their characteristics, there is a category of risk that is assumed there that is not on a 30-year fixed, right? If you're choosing to take a 5-year interest-only ARM, you should plan for it, right? You should be monitoring the market, and if a refinance opportunity happens in those 5 years, jump on it, right? I mean, we don't know where rates are going to be 5, 6, 7 years from now, but you can be ready for an opportunity. That's the most important thing. So, I mean, I wouldn't say they're the most risky thing in the world if you have a good plan. I mean, it's just like anything, right? Risk can be mitigated by good planning. But for somebody buying maybe their first rental or the first time they're jumping into the market, would I advise going on an interest-only ARM? Probably not. That probably wouldn't be the first program I'd put a first-time buyer in. But for the seasoned investor who has a portfolio, who has good use of leverage, who has a plan in place for 5, 7, or 10 years, absolutely, I think it could be a useful tool in the right hands.
That's a very good point. It's not for the person who doesn't know what they're doing, who wouldn't qualify unless it was interest only. That was the crap that was happening in 2008.
Yeah, that's dangerous. That's very dangerous.
Right.
If you have to go interest only and otherwise you couldn't have gotten that loan, that's probably not a situation you want to find yourself in. It's something to utilize.
I'll give you some context. So on a loan with a loan balance of $800,000 at a 7% interest rate, the principal and interest would be $53.22 every month. That's what your payment would be at an amortized loan with principal and interest. If you remove the interest portion of that loan, you're going to be saving about $655 a month. So that payment of $53.22 is going to go down by a little more than $650, which means that's extra cash flow that you are receiving. Now, if you go use that cash flow to do something stupid, like make a payment on a Ferrari, those are the people that lose their properties. However, if you're looking at properties for how they cash flow, you're listening to a podcast like this, you're paying attention to the market, you're planning your finances, you're listening to Bigger Pockets Money, you care about financial freedom, you're probably not doing that. So that's an extra $650 a month. If you multiply that over a year, that ends up being $78.60 a year over the 5 years or let's make it the 7-year period of time that you have the interest only loan. That's saving you $55,000. Now, if you're actually saving that money, if for some reason you can't refinance out and rates start to go up, you have a $55,000 cushion before you hit a foreclosure problem. And that's not including all of the normal cash flow the property is making. This is just the savings from the interest only loan, right? So I want to make it clear. We're not saying, oh, you can't get a loan. We'll go interest only. We'll approve you there. Absolutely not. But if you're a responsible investor, this could be an extra $55,000 over that 7 years. It could be another down payment on a house, an improvement to the property, or you could buy the rate down from whatever they are at the time, and you could get it to where the rate that you've had. There's a lot of options that you have when you do this right. And this is the first time that we've seen that some of these tools that are available to investors in a healthy market can be used versus the last time we saw them when it was all toxic.
Yeah, you haven't been able to do rate buy downs. You haven't been able to get seller credits and do these things for a very long time. But I really like that argument. I mean, even if you're planning a 5-year refinance down the line out of your interest-only ARM, use that money that you save to buy down the rate once you get to that refinance, right? I mean, you have a free rate buy down at the end of the day. I mean, there's so many different things but once again, I just want to reiterate, the plan can mitigate the risk because it's not without risk. But if you plan correctly, that's what makes an ARM something worth utilizing. It's not something when you don't have a plan.
That's exactly right. And this is also, we're discussing worst case scenarios, right? Odds are over a 7-year period, rates are going to go down lower than what they are right now. And you're going to refinance into a 30-year fixed rate. This isn't even an issue. And so I've got several properties that I'm buying the same way. I'm using a 5-1 ARM, and I think rates are going to come down in that 5-year period. If they don't, I'll have all these savings that I'll be able to refinance into a fixed rate, and I can buy it down. And if they don't, I'll have all the cash flow from the properties. And if that isn't enough, I'll have all the money that I'm making from other ventures. So the odds of me losing properties because of an adjustment rate mortgage are pretty much none. But that doesn't mean that everybody is in that position. So when you reach out to us or your mortgage broker, that's what you should talk about. Is what would I do if, and actually talk through that. I love your idea of having a plan. Yeah. Christian, for people that want to follow up with you, ask you more questions, learn more from us, how would you recommend people get a hold of you?
The One Brokerage site is a great resource, theonebrokerage.com, all spelled out. We own the domain for the number One Brokerage as well, so they'll all redirect to the same place. And my email, christian@theonebrokerage.com. And for those of who've had a big outcry of offering it, I'm actually creating social media. So I will pretty shortly have an Instagram, TikTok, all that good stuff. So in future episodes, I'll have a little info about that. But as of right now, email on our website is absolutely the best place.
Yep. And if you go to theonebrokerage.com, you'll see a section there for webinars. You can click on that. And Christian and I do free webinars where we teach people about the mortgage industry. Sometimes Christian does them himself. But if you're looking to learn more about this, or if you consider a career, let us know about that. We are hiring loan officers and we are hiring aggressively. Any last words before we get out of here, Christian?
No, I think that was good stuff. Obviously, always happy to be here. Thank you, David.
All right. Thanks for being here too.